Start. I hope everyone is able to see my screen. Okay. So, uh, okay. So the very basics of options, right? We will not get into option Greeks because that is not required for execution of our Nifty positional strategy. So we'll keep this very basic. Okay. So what we'll go over the concepts first. So I'll take option chain as a reference. Okay. So for those of you who don't know option chain, what option chain is, basically for every FNO instrument, right? For every FNO uh, stock or indices, right? There's an option chain which tells you about what are the premiums available at every strike price. So let me go over every terminology one by one. So for example, let us take the index option chain. So this is specifically to Nifty. Okay. This is NSE website, Nifty instrument, and we are looking at the upcoming expiry, the 9 December expiry. So for Nifty index, there are 4 weekly expiries, and the fourth expiry normally is the monthly one as well. Okay, so every week there is expiry. By this, we mean that in Nifty there are multiple contracts. So if you see Nifty at currently it is at around 26,186. So let's say if we take a round figure, this is 26,200. So this is basically called a strike price. Okay, and in Nifty we have a strike price at every gap of 50 points. Okay, now at every strike price there is a premium associated with it. So if you see this particular column, the LTP column is called premium. Okay, so if you see for example 24,000, okay, we are at 26,000. Can I request everyone to be on mute, please? Yeah, thank you. So if you see this, for example, at 26,000, there's this LTP value is called premium. Okay, so just bear with the terminologies for now. You will understand it in a while. Now, there is a concept of put and call in options. Okay, so what do we mean by put? For example, let's say your view is that market on 9th of December, okay, on the 9th of December expiry, let's say the market is gonna go down. That is your analysis of the Nifty index. So how can you play this view, right? Uh, one option is that let's say your analysis says that market will go to 26,100. Okay, so what you can do is you can let's say buy a put of 26,100 if your view is that market will go below 26,100. Okay, so what will happen currently when you buy a put, you will have to pay some premium to the seller who is selling that put. Okay, so consider this as a normal vegetable market. Okay, you're going and buying a commodity from someone. Okay, so you pay the price to buy that commodity. Um, Matu, I am recording this video, so I will share the recording later on. So, guys, you don't have to request for recording of this session. Okay. Um, so yeah, consider this as a vegetable market where you as a buyer are going and buying something, okay, and there's a seller who is going to sell it to you. So similarly, all these strike prices, right? All these contracts get traded in the market. Okay, these are all contracts that get traded in the market. So if your view is that the market is going to go below 26,100, you can go ahead and buy the put option of this particular strike price. For this, you will have to pay, let's say, 37 rupees. The current premium of this strike price is 37 rupees. And then there is a seller, because you're going to buy it from someone, right? It's a zero sum game, right? So if you buy from someone, there has to be a seller who will have to sell this to you. So there'll be a seller who will say, okay, I'm ready to give it to you. You give me 37 rupees. So that is how a transaction takes place. Now, Similarly, if your view is, let's say the market would go above 26,300, what you can do is you can buy a call option. Okay, a call option of 36 rupees. Similarly, there'll be a seller who will sell that to you and he will take that 36 rupees. Now, why do we have these two different type of concepts, right? Put and call. So put is something when the market is going down, right? And if you want to gain out of that, you can buy a put option. So all the contracts that you see on the right side, right? These are all put contracts. There's put mentioned here. And all the contracts that you see on the left hand side, these are all calls. Okay. So inherently, there are two ways to make money in the market, right? So there is one buyer and one seller. Now consider this. As I said, if your view is that the market is going to go down, what you do, you buy a put, and let's say if the market closes at 26,050, okay, for example, then this 37 rupees, it will become 50 at expiry. So what will happen is you pay 37 rupees, but you gained 50. So you made a profit of 13 rupees. So when the market goes down, one way you can make money is buy a put option and hope, or like basis on analysis, hope that the market goes below this strike price, and then whatever premium you are gaining here, that will be your profit, subtracted by the amount that you are given. So let's say if this becomes 50, you gain 13 rupees. If market, let's say, closes at 26,000, this will become 100, so you will gain 100 minus 37, which is 63 rupees. Similarly, on the call side, when the market moves up, if it grows beyond 26,300, you pay 36 rupees, and if it becomes 50 at expiry, your profit will be 14 rupees. Correct? If it goes to 26,400, your profit will be 64 rupees. So basically, with options, what you're doing is, now try to understand it this way. Um, Now let's say your view was that the market will go above 26,300. Okay, so you bought this option with 36 rupees. Okay, now what is the worst that can happen? Worst, the best is that the market crosses 26,300 and you get profit. The worst is that the market doesn't reach 26,300. It expires below this value. Then what will happen? This premium will become zero. Okay, so when you are buying an option, okay, at the onset itself, you know what is your maximum loss. Your maximum loss is the premium that you have paid. So 36 rupees is what you will lose. 36 into the lot size of Nifty, which is 75. So somewhere around 2,500 rupees is what you will lose. So you know this beforehand. Okay. Let's say you know your analysis says that market will go to 26,500. Okay. 300 points above this, and you buy a call option of 5 rupees 50 paise. Okay, so for discussion, let's take it 5 rupees. So you know that your maximum loss, if the market doesn't come here, your maximum loss is 5 rupees, which is 75 into 5, basically around 375 rupees. Okay, so one way to play the market, if your analysis is good and if you're good at um, analyzing what direction market is going to go into, is that you buy a call option when the mark when you think that the market is going up, or similarly buy a put option when you think that the market is going to go down. Okay, so in both these cases, you know that what is your initial risk. Correct? As I said, you are paying just this premium. So worst case, what would happen is you will lose this amount, right? So is this clear? Is this point clear? If I could get a couple of uh, yes, okay, okay. So now we have talked about buying, okay. But when you are buying, okay, so let's say person A is, I am going to the stock market and I'm saying, okay, I want to buy this particular strike price. Now there is someone who is selling this also, right? Is there's a buyer, there's a seller also. Now understand this thing. You came and told me that okay, I'm ready to buy this 36 rupee call option. And I said, okay, I will sell this. Now your risk is defined. As I said, your risk is 36 rupees. But if the market goes to 26,500, right? How much will you get? You will gain 200 rupees, correct? Because it is 200 points away from the uh, option that you have purchased. So you will make a profit of 200 minus 36, which would be 164 rupees. Okay. But I, as a seller, I why would I sell this option? I would sell this option because I have the opposite view. which means I am very certain that the market will not come till 26,300. Correct. So that is why I'm selling this. But when the market has crossed this and it is expiring at 26,500, so what would be my loss? My loss would be opposite of what profit you have gained, right? So I would be having a loss of 164 rupees. So that is how a transaction would take place, right? When someone is buying from me, I have the obligation that at expiry I will have to complete that transaction. So I will take a loss of 164 rupees and the buyer will get a profit of 164 rupees. Correct. Now try to understand this. The buyer, when he's buying the option, he knows what is his maximum risk. That is 36 rupees as I explained. For a seller, I am taking a lot of risk. Why? Because I don't know what my maximum risk would be. If let's say Nifty goes 1,000 points, expires 1,000 points above, right? Let's say 27,300. It is possible. Anything is possible in market, right? There's a open circuit or something like that, and Nifty expires at 27,300. My loss is 1,000 minus 36, which is like 974 into 75. So that is the quantum of my loss. So a seller is always having more risk than a buyer in market. So keep understand this concept. A buyer always has a limited risk. A seller always has unlimited risk. So whatever we are discussing on the call side, same applies on the put side. Okay. So how do we make money in market? If if we know that the market is going to go down, either you buy a put option or you sell a call option, as I said, right? If I am of the view that market will not go beyond 26,300, it will go down, I can either sell this or I can buy a put option. When I buy a put option, my risk is limited. When I sell a call option, right, with the view that the market will go down, my risk is unlimited. Vice versa on the put side. If you think that the market is going to go up, you can either buy a call option where your risk is limited, or you can sell the opposite side. You can sell a put option and have unlimited risk. Okay. So this is basically what a call and put means. This is basically what buying and selling in market means. All the strategies involving call and puts are created on the basis of this. Okay, so there can be thousands of strategies that you can create with this idea, but the basic concept is that buying a put means market going down, buying a call means market goes up. I mean, your view. Buying a put means your view is market going down. Buying a call is your view that market is going up. Selling a call is means that your view is market is going to go down. Selling a put means your view is that market is going to go up. Okay. The session would be recorded. You can play it again and you will understand if in case you have you still have some confusion. So that is the basic idea of call put. Okay. Now so we will not go into a lot of details. This option chain, if I start to explain this itself, will take one entire day, right? So this in itself is a lot of thing to understand, right? Like what are IVs, what is bid, what is us. But for I am going to explain all the concepts from the point of view, what is the prerequisite for trading our option strategy. So we'll keep it limited to that. Otherwise, there's a lot of content on YouTube, or you can reach out to me as well if you have any queries other than the things that I am discussing. Okay. Now that we have understood put, call, market direction, what do we play, and what is a strike price? Okay. So this is what we have discussed. Now let's see this thing. What what are the basic strategies which will help you understand how to trade market? See, as a beginner, we all don't want to lose out a lot of money. Okay, we want to play around, understand things, and then probably increase and allocate our capital. Okay, so now basis on this concept, right, where some of the strategies have defined risk, some of the strategies have undefined risk. Basis the fact whether you are buying, selling, or what, right? So let's go over and understand one by one. Okay. So for example, now let's say we'll take the monthly expiry. Okay. Now let's say we are anticipating that market will close. Try to understand this. Pay a lot of attention because I will link it step by step. How you can trade naked and then reduce your loss, increase your profit. I'll cover all of this. Okay. So I'll go step by step. Try to pay attention. So now our view is that market is going to expire over 26,500, whatever your analysis says. Okay. So as we discussed that if we want to trade a bullet, if we have a bullish view, what we can do, either we can buy a call or sell a put. Correct. So what I will say, okay, my view is that the market will cross over 26,500. Let me buy a call option. Okay, 30th December 26,500. This is okay for those of you who don't know. This is Opstra tool. It is primarily for creating your option strategies, backtesting them, right? All of that. There are other options as well, other platforms as well, like there's Stockmark, there is Sensible. So whichever suits you. Okay. So now see this chart. You have, I said when you are buying a call option, right? When you're buying an option, put or call, you know your maximum risk. So we know that worst comes to worst, whatever happens in the market. If let's say tomorrow market circuits up 20%, goes down 20%, whatever happen, sorry, if market goes down 20%, if there's a major news, some war happens, anything happens, I know my major loss is 12,431. How did I get this? 165 into the lot size of Nifty, which is 75. So that comes 12,430. I know this. But now see, the probability of this strategy being successful is when it crosses 26, um, when it crosses 26, one second, 26,650. Okay. Why 26,650? Because 26,500 is your view that it is going to go above this. Plus, you are paying this premium, right? So the value at 26,500 plus 165 is the amount from which you will start to get profit. Okay. So which is basically somewhere around 26,650. Now above this, right, you will have unlimited profit. Now let's say Nifty expires at 27,500, for example. So your profit will be somewhere around 63, 64,000. Okay. But, and if it goes even further, your profit will keep increasing. Okay. But there is a larger probability that you might not make profit in this strategy, because it says that there is a probability of only 23% for you to get profit here. If even if your view is right, but let's say market expires at 26,400, you are still going to lose the same amount, 12,431. Okay. Now let's see if we want to sell put, and let's say your view is again that the market is going to go above 26,500. So you will, let's say, sell a put. Okay. This is what we discussed, that there are two options, correct? Either buy a call or sell a put. Now here you will make a defined profit. Okay. But see, your risk is unlimited. If market gaps down 10% and again gaps down 10%, again gaps down. So there is no limit to which you can face loss in this strategy, right? So that is why a seller always faces more risk in the market, because his loss is unlimited. His profit is defined. He cannot get more than this profit, because the profit he will get is the premium he is pocketing. So 215 to 75 is what he will get. But his risk is undefined. Correct? So this is what we say. This is called naked buying, where you just buy a call option. This is called naked selling, where you are just selling a put option, right? You are not hedging, you're not doing anything. It is either it happens or doesn't happen. Okay. So it's like 0 or 1. Either you profit or you loss, or you make loss. Same case here. Either you make a loss or you make a profit. Okay. So uh, now this is the very basic. Okay. This basically tells you what happens when you just buy a call or you sell a put. Similarly, if you are having a view on the downside, you can visualize, right? You can just buy a put or sell a call. Now, let's say we want to play this more smartly. Okay. Our view is that, okay, I don't want to lose out on this much money. There is a chance that market may go above 26,500, but for in fact 26,600 here. But I am still not very confident on my view. So I don't want to risk a lot of money here. So then what do we do? Okay. Let's say we will go ahead and sell a call option. Now see this. What happened now? Your risk has become defined. and it has reduced. Earlier it was 12,000 something, right? Now it is only 5,200. So your risk has reduced, but your profit capacity has also reduced. Earlier you could have made unlimited profit, but now your profit is capped at 9,700. This is basically called a bull call spread, wherein you have a bullish view, but at the same time you are also selling a call option uh, a few points ahead of your buying position because you want to limit your loss as well. Okay. So this is one of the strategies now as a beginner, right? If you want to experiment in the market, instead of going with our previous strategy, which was this, right, where you were losing 12,000 rupees, you can probably go with this, where you know that your risk is less. Even if your view doesn't work out, you will not lose as much as 12,000. Correct. So this is basically called a bull call spread. So you are limiting your losses, but you're also limiting your profit. Now notice this, okay? Your profit was 97, loss was 52. Let's say I take, if I go 100 points beyond, your profit increases, but your loss also increases. If I go 100 point less, your loss decreases, but your profit also decreases, right? So this is how you can now play according to your view. You can play with the strategies in live market. Okay, now you know that your loss is capped. So you can take a strategy which has lesser loss, and if your view goes right, you can make profit. Otherwise you will not lose out a lot. Okay, so this is called a bull call spread. Similarly, on the opposite side, when we play with the view that the market is going down, it will be called a bear put spread. Is this clear? You can always rewind the recording and see later on. But does this give some idea of how strategies are created and how you should not go with naked scenarios? Okay. So this is basically called a bull call spread. The opposite side would be called a bear put spread. Okay. Now this is a one-to-one strategy. These are defined strategies. Now, and if you notice these are also directional in nature, right? It will only make money if the market moves, let's say, X number of points from here, right? So one set of strategies are directional strategies, other set of strategies are non-directional strategies. So let's take a look at a non-directional strategy. I'm sure you guys would have heard about iron condor or iron fly, right? So let me tell you what that strategy is. This will help you understand. So this sort of strategies you can play when the market is strongly directional, okay? But 70-75% of the times our market is range bound. So how do we trade that? Okay. So for example, your view is that, let's say, market will not go will stay between, let's say, 26,000 and 26,300, for example. Okay. Let's just take this view. Okay. So now your view was that market, let's say, will remain between, let's say, 25,600 and 26,600. Okay. So let's say you have a view and you created this strategy. Okay. Now if you see on the legs, like if you go beyond the break evens, you see that you are still getting unlimited losses. So what you can do, you can cap your losses. How? Just buy a lot outside this, for example, and buy a call option outside your sold leg. Okay. So now see this. If your view goes right, which is range bound, okay. So you are saying if the market stays between 25,900 to 26,375, okay, roughly 400 points. If the market remains in this 400 point range, I will make profit of 5,600. Okay. You make a profit of 5,600. But if market goes beyond these, okay, let's say your view was range bound, but market turned to be directional or volatile, okay, and it went beyond these, then you will incur a small loss of 1,800. Okay. So what type of strategy is this? this is a non-directional strategy, but a risk-defined strategy. Why this is a risk defined? Because you are selling or buying equal number of lots. So whenever you're selling or buying equal number of lots, your risk will always be defined. Okay. So this is an example of a um, non-directional risk defined strategy. So this is popularly called as iron condor. Now you would have also heard about iron fly. Iron fly is nothing but you basically sell the same, you sell call and put at the same strike price. So we sold a put at 26,000. We'll also sell a call at 26,000. And then let's say we will buy a call of 26,100. Okay. So this basically means that you are selling both call and put at the same strike price, at the same strike price. Normally we go for ATM strike price, basically wherever the market is at the money strike price. Okay. So these are just different variations. So this again, because we are selling and buying equal lots, we are again doing a risk defined strategy, which is non-directional in nature. Okay. So now, as you can see with these combinations, right, you can create n number of strategies, thousands and thousands of strategies you can create. You can have, you can you can keep one lot here, one lot there, one, you can modify iron fly, you can modify iron condor, or you can modify directional strategies, right? So but these are whatever I have told till now, these are all risk defined strategies. Your loss is defined. Now let's say, for example, let's say we'll talk about our strategy. What do we do and why is it different from this? Okay. So for example, let's say call, we'll sell 800 points away, let's say call. Okay. And we will sell, let's say, 1,000 point away put. Okay. Just for example, okay, this is too less, let's say 25, 200. Okay. Now again, this is a risk, um, not a risk defined strategy, right? This is unlimited risk you can see on here. Now if I buy a hedge, basically iron condor, okay, if I buy a leg outside 27,000, okay, so for example, if I buy, let's say 26,800, 26, sorry, 27,200, sorry. Let me buy a call outside this and let me buy a 25,000 put, okay. Just you will understand once this graph comes. So ignore this blue line, must be some anomaly, okay. But see this. So again, I have a 2,000 point range, 25,000, almost 25,000 to 27,000, in which if the market expires, I'll make how much? 1,700, 1,800 rupees. Okay. But if the market expires beyond these break even points, I will make a loss of 13,000. Okay. So this is now a risk defined strategy. I know my risk. But imagine this, okay? Um, if the market starts to move, let's say 400, 500 points down, you will not have the appetite to hold on to this position, right? Because you will always be in a fear that what if market continues to go 500 points more down? Then my loss, then like there's a probability that my loss will, the loss scenario will become very real, right? And you will start to panic, or you'll start to close your position, or you'll start to do adjustments if you're good with that, right? And precisely, and this is precisely why I do not trade these sort of strategies, because if you see, your selling legs are nearer to the current market price, and your buying legs, which are basically hedges, right, they are away from your sold legs. So whenever volatility happens, right, what would happen is there will, as long as it is range bound, this is fine. But when market starts to move in any one direction, you will start to worry, because these hedges are not giving you very real protection as such, right? Because they are outside your sold legs. So that is why I normally don't trade this type of strategy. What I do is, what I'll do is, I will sell more lots. For example, let's say I increased my sold positions, and I will bring the buying legs inside my sold legs. Okay, so if my sold leg is 27,000 and 27,200 is beyond that, I will do 26,900. Okay, and here I'll do 25,300. Okay, I'll explain this. Wait. So now see what happens. This uh, earlier this was a risk defined strategy. Now it has become an unlimited risk strategy. Why? Because our sold lots are greater than our buying legs, right? We have sold two quantities, but we are buying just a single quantity. Okay, so that's why you see that the unlimited risk scenario happens here. Okay, but if you now see that when the market is moving 200, 300, 400 points in either direction, right, I will not be uh, I'll not be concerned much with this small amount of move. Why? Because my inside hedges, these are called inside hedges. Okay, the inside hedges value will increase faster than basically the premium of these inside hedges will increase faster than the premium of my sold positions. So it, in my experience, it is better to take inside hedges. It helps in mildly volatile scenarios. Okay, so range bound, I will continue to profit, and in mildly volatile scenario, I'll continue to profit. Obviously, when the volatility is very large, I will have risk because this is a risk defined strategy. And due to this only, I basically keep the multiple weak hedges, right, to offset the risk in the main strategy because this is a unlimited risk strategy. So that is why I focus more on inside hedges and I don't go with outside hedges. All strategies such as iron condor or iron fly, they basically are outside hedges strategies, which doesn't suit me much. I trade this strategy in a way that I don't want to be in a scenario where I have to do too many adjustments. Okay. So I hope this will give you an idea of how to create strategies, how to play around with strategies, why I focus on although it's an unlimited risk strategy, but why it works for me because I create a very large spread and I keep expiries in multiple weeks. So for details of strategy, obviously we can you can follow the group wherein you get regular end of day updates, or you can reach out to me if you want to understand it better. I can have a session with you. So that is more on the strategy that we follow. Right, so this is what I wanted to cover in basics. I'll share this recording. You guys can go over it. There's a lot of content on YouTube on what option basics are. Don't get into option Greeks. Option Greeks are very complicated for our strategy, not required at all. Since we are positional, uh, we don't need option Greeks. You can rewind this video, see it. I hope it will clear some of your basic doubts. At least whatever is needed to trade my strategy, I have covered all of this here. Okay, and if you have any doubts, you can reach out to me personally. I can respond to that. And now you have some base. If you are not much familiar with options, now you have some idea of what call, put, strike price, what are basic strategies. You have some idea about that. This is pretty much what I wanted to cover. I wanted to keep this session short. Otherwise, this is like a book in itself. We can go for days on days. We can discuss so many things about options. It's a complicated instrument, but we don't get into that much complexity. For us, we'll try to keep it simple. Yeah, that is all I had. If you guys, we don't have a lot of time left. If you guys have any questions, you can ping me, and I can I can take that question. Okay. I hope it has been useful. See suggestion resources on YouTube, right? There is so much content, Mathu. It's difficult for me to pinpoint any one content, and that is why I wanted to cover these topics. So what you can do is whatever concepts we have covered, right? Just search for those concepts on YouTube as well, and whatever relevant videos you find, maybe with more number of views, you can go through that. Okay. What is your experience in negative and Yeah, these are questions I can take away. I can take separately because these are very specific to our strategy, right? I don't want to violate the logic of this particular session. I prefer fortnightly, Jited. Um, I don't go for weekly at all. Okay, so we'll wind up. You can reach out to me separately, ping me on WhatsApp or Telegram. Okay. Okay. Thank you, guys. Bye.